Financial institutions are the key to any economy, and banks are the first to react, be it any economic downturn, recession, or COVID 19 like situations. Also, I'm a strong believer that consolidation in financial sector in India is long overdue and will result in one of the major multi-baggers in years to come, which makes this video even more interesting. Welcome back, friends. In this video, I will be sharing my learnings on how to analyze the key ratios of a bank and how to compare different banks and choose the one with strong balance sheet while choosing your next investment. Let's start with what are the liabilities on banks' balance sheets. All the liabilities are the money which bank has taken in various forms. This money acts as the fund sources for the bank. Reason these funds are considered as liabilities are as they need to be returned one day, and also bank have to pay interest on them, which is also known as the cost of capital. Retail funding refers to the various types of deposits that households and small companies keep with a bank. For example, deposits from customers like savings account, current accounts, and fixed term deposits. This type of funding is considered as unsecured since depositors do not ask the bank to give them any sort of collateral as a guarantee for keeping hold of their money. Wholesale funding for banks comes in many forms, and there is a wide range of types of investors that provide it. A bank may receive this unsecured deposits from other banks, large corporates, pension funds, insurance companies, and many other financial market participants. Can raise secured funds in a number of ways. One common approach is via sale and repurchase of a repo or commonly known as repo transactions. In a repo transaction, a bank sells an asset, for example, a government bond, and agrees to buy it back on a specified date at a higher price. Another common method is the process known as securitization, via which many banks pool together illiquid assets such as loans and transform them into tradable securities to raise funds. Banks most commonly securitize mortgages to create mortgage-backed securities. Mortgage-backed securities are tradable in secondary mortgage market. Last but not the least, retained earnings and the share equity by giving investors a stake in the business. This is when bank raises money from the market and investors like us get the opportunity to invest our capital. These are few ways in which a bank can raise the capital. There are many more ways, but in the interest of time, only the few common ones are discussed here. Let's look at the assets on the balance sheet of the bank. These are the loans, or commonly known as advances, which a bank issues in various forms and earns interest rate on the given capital. Is the loans which are given to the businesses. Whenever we read in a balance sheet of any company and we see short-term, long-term debts, most probably such loans have come in from some sort of financial institutions, and one of the major ones would be banks. Category is the consumer loans. For example, the money banks lend us on credit cards and give us longer time to pay it back by charging interest rate on it. Other similar loans could be loans to purchase cars and other personal loans. These loans can vary in terms of payback period and the rate of interest rate charged on it, depending on the risk the bank sees associated with. And the most common form of loans is the real estate loans, which cover the residential and commercial mortgages or the home equity loans. Banks also provide loans to other banks in need, known as the interbank loans. Period of such loans can vary a bit from being few days to long-term loans. This broadly covers the main kind of loans a bank would end up giving, and the combination of such loans fall into the asset sides of the balance sheet. as this is the bread and the butter for the bank and how banks earn revenues. Put in a simplest manner possible, you need to think of a bank as someone who takes it money from a person A and gives him interest X, and then gives that same money to the person B and charge him the higher rate of interest, which is Y%, say Y. And the difference on the Y and X is what a bank earns. And the money bank receives in forms of deposits forms the liabilities of the bank, along with the money bank have received by issuing stocks to the investors, and the money which is put in use in form of the loans or government bonds forms the asset class for the bank. Let's start looking into a few of the important key ratios to analyze the bank's financials. Net interest margin is the percentage difference between the net interest income a bank generates from credit products like loans and mortgages and the amount of interest paid out to their lenders on saving accounts and deposits relative to the amount of their interest earning assets. That is the assets which are earning interest for the bank, the sum total of the assets. Higher the net interest margin, better is the operationality and the profitability of the bank, as banks with the higher net interest margins would end up earning higher returns for every dollar which is lended to the customers. Negative net interest margin would mean that the bank is losing money in its operations, which is a big red flag. Another important ratio is the CASA ratio. CASA stands for current account and saving accounts. Different kinds of deposits like current accounts, saving accounts, and term deposits forms the major source of funds for banks. Now you understand well the assets, liabilities, and the differences between the two for the banks. As you know, higher the net interest margin, more profitable a bank becomes. And in order to achieve higher net interest margin, the banks need to operate with lower cost of funds. This is where the CASA ratio comes in handy. CASA deposit is generally a cheap source of funds for banks. The higher CASA ratio helps the bank in improving the net interest margin as these deposits come with an interest payment which is negligible for banks. The current account does not attract any interest burden, but term deposits comes with a higher interest burden compared to savings account deposit. A low CASA ratio suggests that the bank is not efficient, as it has to pay higher rates for more expensive type of deposits, which can hurt its net interest margins. This ratio should be considered before investing in banks. As the name suggests, this ratio helps to indicate how much percentage of the total deposits is the bank able to lend out to customers to earn interest on it. This ratio is important in assessing banks' liquidity and operational efficiency. If the ratio is too low, it means the bank may not be earning as much as they should be. And if the ratio is too high, it means that the bank might not have enough liquidity to cover any unforeseen fund requirements, which may affect the capital adequacy ratio and the which we'll be discussing in the coming time. NPAs, which are non-performing assets, are the one of the most important parameters to assess the banks. This is how well our bank is run, indication of its effective underwriting of loans and recovery of the money lended out. NPAs are also the reflection of management's decisions, as bad loans can ruin the profitability of the banks and hence our money as investors. A loan as the a loan is defined as an NPA if the interest on the loan is not received for 90 days. We can broadly categorize the NPAs into two parts: gross NPA and the net NPA. Gross NPA refers to the entire amount of debt that an organization has not collected. Or in simple words, it is the total amount of loans defaulted on by people who have received loans from the banking institution. Net non-performing loans is the amount resulting from the sum of the defaulted loans after deducting the provisioning for the uncertain and the unpaid debts. The formulas for how we calculate the gross NPA and the net NPA is as shown on the screen. Gross NPA reflects the quality of the loans made by the banks. A very high gross NPA ratio means that the bank's asset quality is in very poor shape. Net NPA is a better indicator of the health of the bank. It shows the actual burden on the bank. A higher level of NPA increases the amount of provisioning which is required, thereby impacting the profitability of the bank. It also impacts the NIM, which is the net interest margins of the bank. The core business of a bank is lending, and it has a certain level of risk involved. Tier 1 capital is the amount of money a bank have to keep to make sure it has adequate capital at hand to absorb any unforeseen losses which may come along the way, and make sure that the bank can keep functioning even in the bad times. Tier 1 capital includes the capital raised through equity and the retained earnings, which are also known as disclosed reserves. Tier 1 capital and the Tier 1 capital ratio are good indicators of bank's financial strength. Tier 1 capital ratio compares the bank's equity capital with its total risk weight assets. So what do you mean by weighted assets? These are the compilation of assets the bank holds which are weighted by credit risk. So it is a sum total of all the assets, and they are weighted with the credit risk which is associated with it. For example, a mortgage which has a collateral of a house with it might be less riskier than a loan which is a personal loan which is given out in form of credit cards, or any other sort, and does not have any collateral associated with it. Tier 2 capital is considered less secure than tier 1 capital, and is more of a supplementary layer to the security offered by Tier 1. Tier 2 includes reserves like revaluation reserve. An example of this is the value of the bank's building it owns, and the value can increase in time and must be revalued. Another extremely important ratio is the capital adequacy ratio, known as CAR, and also known as the capital to risk adequacy ratio, which is CRAR. It is a measurement of bank's available capital, which is used to respond to credit risks and liabilities. A good capital adequacy ratio ensures a bank can absorb any potential losses and decrease their risk of becoming insolvent. Therefore, it ensures that the bank is adequately equipped to protect the money of the depositors in the face of financial challenges. It is calculated by adding the Tier 1 and Tier 2 capital numbers and dividing it by the total risk weighted assets. The efficiency ratio, as the name indicates, helps to assess the efficiency of bank's operations, and it is calculated by dividing non-interest expenses by revenue. The efficiency ratio does not include the interest expenses, as they are naturally occurring when the deposits within the bank grows. However, non-interest expenses such as marketing and operational expenses can be controlled by the bank. A lower efficiency ratio shows that there is a less non-interest expense per dollar of revenue, which is hence it is better for the bank. Operating leverage is another measure of efficiency. It compares the growth of revenue with the growth of non-interest expenses and calculated by the difference of the two. A positive ratio shows that revenue is growing faster than expenses, which is definitely a good sign for the bank. On the other hand, if the operating leverage ratio is negative, then the bank is accumulating expenses faster than revenues. That would suggest inefficiencies in operations and definitely should be considered as a big red flag. That's all from my side in this analysis. Please do let me know your thoughts in the comment section below, and do like and share if you like it. Please also let me know if you would like such kind of analysis videos in future, and don't forget to subscribe to the channel for future videos. Thanks for watching, and see you in the next video.